I hope my screen is visible.
Yeah, that is visible.
Okay. Good evening to everyone. We thank all our partners who have logged in on this call. Today, we are here to present to you a unique new investment opportunity. The name of the product is 361 Balanced Hybrid Fund. This is a true to label, first of its kind balanced offering, which will combine the best features of both equity and fixed income asset classes and aim to provide superior risk adjusted returns. To take you through our thought process and the vision behind this product, we have with us today Mr. Anunya Kumar, President and National Sales Head of 361 Asset Management. He will take us through the whole journey, our concept and vision behind this product. Without further ado, over to you, Anunya.
Thank you, Shri, and good evening, everyone. A very warm welcome to all of you, and many thanks for taking out time and giving us an audience. As Shri mentioned, while Shri was introducing this product, she used 2-3 words. One is first of its kind. Second one is smoothen the journey. And to be very honest, I think these are the two very critical aspects of this fund. First of all, yep, undoubtedly, this is the fund which is first of its own kind. And if we move further, you will understand what do I mean by that. So basically, when SEBI designated all the asset classes and the scheme that you all can do, there were 3 schemes or 3 sections within the hybrids which were identified. They were like conservative hybrid, balanced hybrid, and the aggressive hybrid. And obviously, conservative hybrid is what we all know, which is the fund like an MIP and all. Aggressive hybrids are your balanced funds. Now, there is a world in between the conservative and an aggressive, which is the world of balanced. And this fund is nothing but a representation of that world. Now, if you go back to any investor, what is he looking at? He is basically looking at a journey of a wealth creation without too much of a volatility and a smoothing one, wherein we can or he can have an experience of a very balanced risk-adjusted return approach. And this is an attempt that this fund would try to do. If we move further, what are the current investor's dilemma? Any and every investor today thinks, is it a time to invest in equity or a debt? If I have to pick one of the two, how much to allocate? When and how should I be doing the rebalancing? And what should I be investing in terms of ensuring that my risk-adjusted or a risk-adjusted experience is far and better? Now, if one has to look for all of these questions, pretty much many of those do get addressed in a fund, which is in a concept called a hybrid funds. They are the best world to offer solutions to all these dilemmas that investors do carry as we talk of today. Now, why should one be investing in a hybrid fund? It's very simple, because hybrid offers you a diversification wherein you are able to look at your equity, which is largely looked upon as a growth in capital, and a debt, which is more to consider as a stability of capital. So debt and an equity being more volatile and a debt being less, and that's where the a good rebalancing and a good balanced approach to come in. Hybrids obviously are less volatile because of the element of debt in the portfolio, and there is a team of managers who are behind the curtain taking good care of ensuring how much of equity at what point of time one should be allocating. So like monitoring and a rebalancing is an activity that is getting anyway monitored behind the curtain by the professional managers who are basically the ones managing the fund. Now, the beauty is when we talk about a debt and an equity, the times have never been very uniform. If we go back right from 2004, over like 18 to 19 odd years of a journey, what you would notice that the markets have been pretty volatile. There were times like in '04 to '07 where your equities have done very well. And then we got into the subprime crisis where equity underperformed, debt brought in some kind of a stability to the portfolio. Markets recovered after the crisis, again went into economic crisis. Then we had a COVID, so on and so forth. But one thing which is very much visible if we see through this entire slide is there is no uniformity of one asset class in terms of behavior. They have been pretty volatile. Yep, there are times when they have moved in the opposite direction. There have been times where they moved in tandem. Maybe the intensity of the moves could be very different. So winners do rotate when we look at equity and a debt. And so is the low correlation between equity and a debt, as you all can see. Sometimes the correlation is a positive and the correlations are negative. So it's a great, I would say, mix in a client portfolio, debt and equity, wherein you can actually look at a much more balanced risk return profile. So that's also one of the feature that a hybrid fund do provide to you. And that's where it makes a lot of sense. If you can go back to move ahead, if you can go to the next slide next, one more. Yeah. So what are we doing? Let us look at it. When we talk about a balanced hybrid fund, what do we do? This is a fund where your equity allocation would stay between 40 to 60, which practically would mean the residual allocation would happen in debt. And the combination of two would mean a balanced hybrid fund. I said 40 to 60. If you remember, your aggressive hybrid, the equity allocation starts from 65. So basically, it just stays slightly below on equity allocation when it comes to comparing it with hybrids or I would say aggressive hybrid rather. Likewise, you're in a conservative hybrid. When we look at it, your equity allocation generally stays around 20-25%. Here, the minimum allocation to equity is 40. It's a very unique space, 40 to 60 equity, which is the space currently not being occupied by anybody, any fund house. And this is the first fund in the category which is coming in. Let's be mindful of one thing. Any fund house which has an aggressive hybrid fund currently going on, they will not be able to launch a balanced hybrid. So balanced hybrid fund will only come from the stable of those fund houses who are not currently having a hybrid on the aggressive side. So just be mindful on that. So you will not see too many players coming out of the balanced hybrid also if they already have an aggressive hybrid with them. So if we move further, and that's exactly where the, on the risk return parameter, the positioning of the fund is. So arbitrage, as you all can see, is the lowest on the risk and so is on the return. That gets followed up with the conservative hybrid, which you also call MIPs, then equity saving fund, and then your balanced hybrid. And after that is your aggressive hybrid, wherein you take an equity allocation in excess of, or minimum equity allocation has to be 65%. And that, so basically your balanced hybrid is just between your equity savings and aggressive hybrid in terms of positioning on the risk to return chart. Now, this is an important one because the very first question that would come into your mind would be that if debt is going to be, in excess of 60%, or your equity is sub 60, then pretty much the taxation would be debt. Yeah, that is right. The taxation in this product is a debt taxation, but the advantage is you are getting the benefit of indexation. Now look at it, what it means. If I see a product staying with a client for 3 years, basically your balanced hybrid gets you a taxation of 10.65 if I consider income of an individual is within 50 odd lakhs. While an equity hybrid or equity fund rather, or an aggressive hybrid will fetch a taxation rate of 10.4. I am not for a second considering the fixed income because those are anyway on a higher side, 31 because of the marginal taxation. If I go into the bucket of 2 to 5 CR on an income for an HNI, you would see 1248 and 1196. If I consider corporates, again 1215 and 1165. Now, these are the numbers. 1080, 1080, 65, 1085, 1040, 1248, 1190 are the numbers. But more importantly, what you need to keep in mind is the incidence of tax, which is coming on to you. The difference is not even 50 bips. If I have to look at a difference between equity and a balanced hybrid. Equities are 50 bips less on the taxation than a balanced hybrid. Keep this statement in mind because this is very, very critical when we go further. If I move to the next slide, and it is no brainer that if you have a higher equity in the portfolio, your volatility, which is the extreme left, bucket of, the bucket that you can see, the volatility is higher, so is the return. Both return and a volatility on the aggressive hybrid, which is 65-35 component, is higher than a balanced hybrid, which is 50-50 component of equity and a debt. But look at the extreme right bucket. Your risk-adjusted return all of a sudden gives a very, very different picture. Now what you can see is your risk-adjusted returns in a balanced hybrid is much more promising. Remember, previous slide, we spoke on taxation. Taxation in incidence of taxations aren't too steep. The differential is just 50 bips. But on a risk to reward, if you see, this is far and more enriching. If I have to look at conservative or other balanced hybrid vis-a-vis aggressive hybrid. And if I go further, which is just to put some number to the perspective, the one in the shades of purple are the one which is the Nifty 50, which is a balanced hybrid. On your right, the right to that is an aggressive hybrid. What you can see is the return experience between a minimum and a maximum, the delta. Delta is much higher in a hybrid, which is 65-35 vis-a-vis hybrid, which is 50-50. Your ability to generate minimum return is practically zero if you look at a 65-35, while it is still 1.8 in a balanced. And look at the average return. Average return is pretty much, the same, 11.2 and a 12, not too much of a difference. And your ability to generate 8% and more is again much higher is obviously comparable, relatively better in a 50-50 structure vis-a-vis 65-35 structure. If I look at a 5-year rolling returns, the story is no difference. Now let's join the 3 graph. Risk-adjusted return, 50-50 was a better. Your taxation part, 50-50 is not too much hitting on your pocket. If I look at an experience, 50-50 is pretty much on an average closer to what 65-35 hybrid is giving, which is aggressive hybrid, or so to say your balanced fund, as we all call. And your ability to generate more than 8% return in a balanced hybrid is much better or much more fulfilling than what you would have got in a balanced fund, which is 65-35 equity. If I join all the 4 charts together, it certainly gives me a perspective that balanced hybrid is far and more better proposition. And to sum it up, or to put an icing on the cake, look at this chart. If there is a drawdown scenarios, if the markets are which we all know the markets in today's time is relatively well priced. In this kind of a market, if little bit of concerning news or anxiety gets built up, the drawdown structures can be far and more than what we all can foresee. In that scenario, your 65-35, the drawdown that you all can see is almost like a 26%. While your Nifty, normal Nifty 100 can come down by almost 38%. And if you see, and on a maximum drawdowns, and when we look at the 50-50 balanced hybrid structure, it is much lesser than both the other structures. So on your downside, the protections are much better in this fund. Why invest in balanced hybrid fund? It is absolutely true to label. Here we are talking about both in equity and debt, in instruments, the investment getting done in a way that we are looking at maximizing your risk-adjusted return. You will draw the indexation benefits. It provides you best of both the worlds. There is an element of diversification, as we all spoke about it. There is a flexibility, which you all can see, where you don't need to do anything. The reallocations within the asset classes are getting done by the professionals. And all of it together would ensure that there is a science on risk management that you all can experience. So this is one of the very key reasons, the 6 very, very, powerful reasons for one to consider balanced hybrid fund in the portfolio. Now we move to us. Now we have spoken about balanced hybrid fund as a structure, as a category, why one should be having it in the portfolio. But someone has to make a first move, and we are the one who have done this. This is the first of the fund in the category. It is obviously providing a dual benefit of both equity and a debt, and it is also ensuring the containing the volatility for you, so as to ensure that your overall experience of the journey is far and more smoothened one. So these are 3 critical reasons why one should look at our balanced hybrid fund in the portfolio. How are we going to manage it? The equity part of the portfolio will be a multi-cap. We have our own SCDV framework, and we'll talk about it in the successive slide. Our approach is always the bottom up. We are going to maintain that while managing equity part of the portfolio in this fund as well. When we talk about debt, we aren't looking at generating alpha from debt. It is more in terms of in containing the volatility and ensuring that an experience is far and more smoothened one. Keeping that in mind, the AAA allocation in the debt is going to be between 80 to 100. The duration, we are going to keep it between 2 to 3 years, so that we don't want to take too much of an aggressive duration call. Besides 80%, which will be in a AAA, up to 20% we can have in a AA plus. It will be largely buy and hold strategy. We will try and look into the papers which are very, very liquid, and obviously being a AAA, you will all appreciate that liquidity wouldn't be a concern. Idea is to generate a reasonably good experience from a debt, while ensuring that the volatility part of the portfolio gets largely contained. So this would be the debt and an equity portion. Equity is going to contribute largely to alpha. Debt is going to bring in a lot of stability. Now, I did say something at the beginning of my presentation, which is, as per SEBI's mandate, I can actually go between 40 to 60 in equity. But we will not go beyond 15 in equity. We will keep a cap on 50, because we feel that idea is to generate a risk-adjusted return. The moment I start getting more equity in the portfolio, basically I'm adding beta, I'm adding volatility, and I'm somewhere compromising on my risk-adjusted returns. So we will keep the range of equity between 40 to 50, as you all can see. We do not want the allocations or the decision on a 40 to 60 be left on the fund manager. We have got a framework. The framework is pretty much on the price to book. Depending upon what price to book that we are in, that is going to decide what equity allocation would be. Today, we are at a price to book of 3.6, 3.65. There is a very high possibility that we will start the portfolio between 45 to 50. Closer to 45 would be our equity allocation when we started off. And that is the larger message to all of you. Idea is not to compete with aggressive hybrid. Idea is to create your own space wherein equity allocation stays between 40 to 50 and ensure that 11-11 quarter, as you had seen in the previous slide, be an experience for the investor over a long run from the product. Equity philosophies are very, very simple. This is a critical one. This exactly when I said SCDV framework, what do we mean by that? This is the framework. As a house, what we do, we normally keep ourselves invested in a bucket called secular. Secular is nothing but they are set of those companies where ROE and a PAT, arguments are in excess of 15%. That practically would mean they are the bunch of companies where the returns are in excess of 15%, both on a PAT growth as well as ROE. You would see largely the consumption-oriented businesses. As a house, we always remain overweight to what the benchmark weight is in seculars. Opposite to secular are the value traps, where your ROE and a PAT arguments are sub 15. They are generally the company which are either utility businesses, government-controlled businesses, or a PSUs, where money making is not so easy. As a house, we normally remain underweight on value trap vis-a-vis whatever the weight of value trap stocks are in the benchmark. Cyclical and defensive, as you all can see on the shades of purple, that is what we call tactical. Tactical would mean that we keep shifting our position between defenses and cyclicals depending upon what time of market that we are in. For example, defensives, as you all can see, are largely the companies which have generated better ROE and are asset-light companies like consumer durable, consumption-oriented businesses, or your IT or a pharma. Those are normally defensives. Cyclicals are the companies where ROEs got compromised, but one can see a better PAT growth. They're asset-heavy companies, your capital goods, industrials, so on and so forth. So what is our in the crux? What is our overall strategy? Our overall strategy is to remain overweight on secular always, remain underweight on value trap always. These weights are with respect to the weights in the benchmark, and tactically keep shifting positions between cyclical and defensives, considering what point of time that we are in the market. This is our SCDV framework, which we follow to the T, and basis this, we are currently managing all our equity funds. Yeah, keep moving on. That's fine. Yeah, no, just back, one back, one back. That's it. As I had mentioned to you about an equity, now let's come to the debt framework. Debt framework, we are basically, as it was SCDV over there, which is nothing but a secular, cyclical, defensive, and a value trap. Here we follow the concept of R, S, and L, which returns, safety, and a liquidity. Our entire debt framework or a debt philosophy is benchmarked around, we are looking at safety and liquidity being the foremost, and then comes the returns that we are looking at building from the portfolio. So whatever we take, we normally follow the two-pronged process. One is the external rating, one is an internal rating, and then we decide how to take the decisions forward in terms of taking those papers in the portfolio. So you can be rest assured that a very optimal balance is maintained between returns, safety, and the liquidity whenever we are looking at building the portfolio on the debt side. If we move further and we move further, then what we are talking about is why one should be investing today. Now, this is a very classic, argument anybody would follow, anybody would put forward. It is very simple. If I look at a valuation of today, by all means, we are adequately valued to a slightly expensive. And what do I mean by that? we have done some analysis of last 24, 25 odd years, and what we have figured out that market in last 24, 25 years have maintained an average price to book of 3.1. If I add one standard deviation to it, it works out to 3.8. What we have seen, the market generally tops out around the price to book of 3.8. And it finds a great buying opportunity if I take away one standard deviation of from 3.1, which works out to 2.4. So we have seen market getting a massive support and a very big pull up or pullback has got noticed as it gets closer to 2.4, and likewise as it gets closer to 3.8, one can see a drawdown kind of a phenomenon start getting built in the market. Where are we today? Today we are at 3.6. What did I say? Resistance comes at 3.8. So one thing is very clear, we are pretty close to the resistance. Valuations are high. In this kind of time when the valuations are high, it makes a lot of sense for one to start building a narrative around risk-adjusted return rather than return alone. Asset allocation, it's a proven fact that howsoever, whatever you do, if you are looking at creating some serious wealth never gets created by anything else other than doing a good asset allocation in terms of creating the long-term wealth. So this product or this fund is a framework, defined framework on the asset allocation. Very unique time when we are actually at an elevated yield curves, when the equity markets are doing well and the debt market still is on the heightened elevated yield curves. At least what you can get today is a very good yield, even in AAA assets, very attractive yield, even in AAA asset, which you can lock in. And not to take away the fact that recent changes in the debt side obviously has taken away a massive tool for an investor who has a propensity or an urge to invest the money in debt. But if he does it, his taxations become marginal. So if I consider all the 4 point, high valuation, long-term wealth, attractive valuation for the debt side, or the taxation changes, I think it makes a lot of sense for one to consider the fund today in terms of taking it to the clients. Who all should be the people? I think the first-time investors, the people who are sitting on the fence, do not know how to react because the markets every day only becomes expensive. The feeling of being left out is very, very intense. Those are the set of people who should certainly be looking at investing money in this fund. Someone who is always looking at optimizing returns through a good blend of debt and equity. This is a good product for them. Good product for someone who has a time horizon of 3 years and above. It's a great product for someone who is seeking an option beyond conventional debts. He knows that conventional debt is no more helping me build a tax efficient tool. I think this is a good fund to look at for them. And obviously the retirees, the retired individuals who have got the money, but they don't have the risk, but they also do not want to lose on the charm for equity. I think this is a good fund for those set of people as well. So these are the 4 or 5 set of people who should certainly be considered for investing. But my view is also you should not ignore the 6th set of people who are the very aggressive guys, have made some decent amount of money because of great advisories being done by you people. But there is no harm taking out some profit from the current investment and putting that part of profit or some part of capital as well into this fund so as to at least build some kind of protection in case market decides to go downwards or market starts showing the signs of easing off. So I think that for those kind of set of people, also this fund, besides the 5 designated classes or the set of investors that we have found, I also feel for anybody who is in the capital market, this also fund makes sense for even him as well. As you all can see, this fund is opening on 4th of September. the NFO will be on till 18th of September. The fund will get reopened on 3rd of October. The fund currently gets managed by Milan Modi, who manages our debt portfolio, Mayur Patel, who has been managing our equity fund. All the equity fund, like a focused equity, flexi cap, is getting managed by Mayur. It's an open-ended fund, as you all can see. Just remember, the benchmark for this fund also is Nifty 50 Hybrid Composite Debt 50/50 Index. So when we talk about keeping our equity allocation between 40 to 50 or between 45 to 50 to be more realistic, I'm actually keeping ourselves pretty close to the benchmark also. I'm not trying to overdo the benchmark and get some risk onboarded in the portfolio which is not warranted, because the benchmark itself gives me a guidance to keep 50/50 on equity and non-equity. I'm sure by now you would have understood this is a very simple fund, nothing to talk, nothing which is very exotic, very, I would say, very scientific, or something which is very complicated or complex. It's a simple fund where we have tried to work on a strategy in terms of building a better risk-adjusted experience for our clients. That's it from my side. I'm very happy to take questions. Feel free to open up.
Requesting participants to please type the questions in the chat box. We'll be happy to address them.
Great. I can understand this is not a very complex product. So it's a very simple one. So, I'm not surprised if I'm finding too many questions coming in. All I can say is be careful on a couple of things. I know there's a lot of exuberance in the market, a lot of exuberance purely on account of, a lot of liquidity flows, so on and so forth. But when we look at ourselves as an advisor, one of the responsibility that we do carry is to speak the language which is the correct language for the investors. Believe you me, if investor would have understood what is needed for him, then he doesn't need us. He needs us only because he himself isn't very clear what is good or not good for him. In a situation like this, when the herds approach with the herds mentality, and everybody probably would want to only have a micro cap or a small cap in the portfolio because it's creating some amazing returns on every daily basis. It's very important that we also balance the portfolios. And when you look at a balancing the portfolio, I think this is one of the fund which would certainly help you build a better narrative. So keep that in mind when you are going to the investors. You have something which can still give him 11 quarter kind of a return with a much better risk parameters or a matrix, and you are actually not getting pulled up on the taxation piece as well. The taxation is equally comparable. As I had mentioned, just a 50 bips more, not beyond. But by paying 50 bips on a taxation, that also on the capital gain, in the return, what you are getting is a much better smoothened experience for the client. Keep that in mind. We don't know what is ahead of us. What we know is client is going to stay with us forever. I think that's something which is beyond debate. What you and me can keep debating upon, how the sun of tomorrow would get us in the offering. I don't know. I'm pretty sure none of us know. But we know one thing, that our clients are going to stay with us for life. So with this, on this note, I thank you once again for taking out time, giving us a patient listening. My teams are there on the ground. They are in touch with you all. Feel free to reach out to them. Anything that you need from our side, we are very happy to serve. Thank you. Bye.